Are live. It has been 2 weeks, 2 weeks since we did Thursday night stock charts live. I did a 9-state tour of the East Coast. Stayed in Charleston, Savannah. Visited Jekyll Island, where the Federal Reserve was founded. Very, very interesting. Very, very beautiful. Then down to Miami, South Beach. Awesome. Met Jamie Foxx. Interesting. Then went up to Tampa and Thanksgiving, a wedding, awesome time. Great to be back to work. And the entire time we were trading earnings and we did very, very well. So what we're going to talk about tonight is earnings season. How did we do? We're also going to talk about Omicron, whatever it's called, Omicron. Get afraid. You got to get afraid. If you're not afraid, you must be a racist. Also, what else? We're going to go over the weekly charts. We're going to talk about the weekly charts, how we're setting up for the new trading week. This is when we begin thinking about next week, not tomorrow, but tonight. And what I always like to say is while we're going to go over the weekly charts on a Thursday night, we have one trading day left to go. A lot can happen. And on Saturday with members, we reconvene and then we go over the week ahead commentary. That's where we review our strategy for the new trading week. And let's get to it. I hope everybody had an awesome Thanksgiving. Mine was really, really, really good. And it's good to be back to work. I was traveling around with my laptop microphone. It was driving me crazy. I'm sure it was driving you crazy as well. The horrible audio, but hopefully this is better. I think so. All right, let's share my screen, pay the bills. And first up, we're going to talk about our friends over at TrendSpider. Folks, during my travels, I tried my best to stay away from the laptop, which I did. And I relied a lot because I did a lot of driving, a lot of traveling. I relied upon the app, the mobile app from TrendSpider. It was awesome. Automated technical analysis in your hand. It was great. So don't settle for ordinary trading software. One up your game, scale up, use artificial intelligence to identify historical support levels, historical resistance levels, to identify great exit points and great exit points to get out of your trade. Save time and use the trade alerts, which I'm going to use later on when we go over some stock chart requests to show you how we use the alerts to identify good risk reward entry points. So TrendSpider, 35% discount code below. Join now, take advantage of it. Cheapest price on the web. So let's begin first with, I got to do this. Let's first talk about earnings season. Earnings season was awesome. It continues. It will continue into next week. We've traded so far, all profitable trades. Microsoft on earnings, AMAT on earnings, NVIDIA. I was down in Charleston on this one. Profitable trade. We opened up a new trade on this one. These are all strangle trades, all option selling trades. We did not buy one common share of stock into earnings, nor did we short. We sold options. We did not buy options. We were the casino, not the gambler. We collected premiums. That's what we did, and it worked out very, very well. Zoom, we booked profits there. Salesforce.com, Salesforce.com, CRM, book profits there. CrowdStrike, book profits there. Snow, book profits there. I was going to let this trade expire worthless, but I saw an article on IBDinvestors.com. Buffett was talking about the stock, or it's one of Buffett's plays. I saw the stock moving up, exited. We didn't want to let our profits evaporate. So it's been a great earnings season. We have a few left to go, a few trading days left to go before earnings, and we plan on trading more. So if you're not currently a member, sign up. The membership pays for itself. Okay. I thought a lot about what I was going to talk about tonight as we return from a hiatus. And what I really want to talk about is fear porn. Let's first put things into context, okay? And this shouldn't be a Republican thing. It shouldn't be a Democratic thing. It should be a common sense thing. It should be an analysis of the stock market based upon fact, not fear, not anecdotal evidence, but of logic. We want to use logic. Now, the leaders of this country at this point in time, and I'm talking uniparty stuff here. I'm talking Republicans, Democrat, all sorts of wonky, how do you say, ode to the special interest groups type of thinking. Sell out the American people, say what you got to say, just get the job done. Here's what's leading the country right here, right now. This type of thinking.
So when a huge group of criminals organizes themselves and they want to go loot a store, a CVS, a Nordstrom, a Home Depot, until the shelves are clean, you think that's because of the pandemic?
I think a root cause in a lot of communities is the pandemic. Yes, go ahead.
So when
Okay, so this is our leadership. This is the spokesman for the president of the United States, a complete and utter idiot. This is a complete and utter idiot, not a friend to you, not a friend to any capitalist out there, not a friend to the taxpayer, just a moronic idiot. And if she's not an idiot, she's nefarious and should go straight to prison and be fired. So this is what's leading the country, and this is what we find ourselves in, this frame of mind. And it's only going to get weirder as we near the midterm elections because the Democrats, the leftists are desperate. They are poised for a wipeout. But don't think that there's a knight on a white horse coming when the midterms come and they go and the Republicans get power, because they are no better. Actually, they're slightly better than the Democrats. But it's a uniparty. They all play the same game. You're a good cop today. I'm bad cop today. We'll play the new game tomorrow. We'll switch roles. So vote in the primaries. Get rid of these rhinos if you want change. Republicans in name only, the Mitch McConnells, Kevin McCarthy's of the world, they got to go. Get rid of them. They are your enemy. I digress. So what the name of the game is right here, right now, is to get you afraid. Now, we're only going to talk about this from the perspective of investing, okay? They want to get you afraid. So you go onto Zero Hedge, and this is what you get. And I love Zero Hedge. Staggering one-day moves. Nomura warns the market remains shockingly dysfunctional. No joke. Why is it dysfunctional? Second case of Omicron is vaccinated adult male, mild symptoms, blah, 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 blah. Get afraid, get afraid, get afraid. Colorado confirms third case of Omicron. New York counts most new COVID cases since January. This is not a shock. This is not a shock. Florida has their COVID spikes in the spring and into summer. Why? Because people go indoors. They go into the air conditioning. They get closer. Therefore, they spread disease. Counts go up. In New York, it's cold now. People go inside. They want to get warm. They spread the disease. Counts go up. This is pure logic. Doesn't have to be fear porn, but that's what they want. They want you to get afraid, get afraid, get afraid. Why is Omicron being treated like Ebola? I don't know if I'm pronouncing this correctly or not. Omicron. They just want more fear porn. But when you take a look at the statistics, and God forbid you do this, God forbid, you are not allowed to do this. How dare you? You're racist. Omicron. I'm sorry. This is from Omicron. I can't stop saying it. This is the coronavirus statistics. USA. This is weekly trends. Weekly case count down 12%. Weekly death change down 22%. But we'll always see Omicron, get afraid, counts higher, blah, 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 blah. And you would think that the states with the most precautions, the ones that care the most about their citizens, with the COVID passports, the 25 masks on their face, would be doing the best. No, California, by far the worst. New cases, 5,000 new cases versus Florida, comparable population, 2,000 cases. I just got back from Florida, South Carolina, wide open. Not an issue. They wear plenty of people wear masks voluntarily down there. They take precautions. They use common sense. If they feel they should wear a mask, they wear a mask. It's not that there are no masks down there. It's just that people have the option. They use their logic, their common sense. So California, with all the precautions and all this, that, the other thing, the highest rates by far in terms of deaths, in terms of new cases. You can't make this up. This is the statistics. So what's really going on in this market? To a certain extent, it is this. Okay, it is the Omicron. But it's not the disease in and of itself. It's the fear of the government. It's the fear of what they may do. Will they lock down? You saw a sell-off in oil. Why? They're afraid of a lockdown. Biden just said that there will be no lockdown yet. But I'm telling you right now, if these polls do not change in their favor by the midterms, there will be lockdowns because there will be mail-in voting, and that's how it's going to play out. But up until a couple of days ago, the markets had begun to stall out. This is before Omicron and the fear porn of the disease. So let's talk about the mechanics of the market and what's really going on here. So first, we want to talk about seasonality. Let's go over to TrendSpider for a moment. And this is their seasonality function. And you can go back, we can go back to 2000, December, a very, 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 very favorable time of the year. Normally, over the past 15 years, it's up 71% of the times. November, about the same. Is it 71 or 78? 73. November, about the same. So these are 2 months, last month, this month, seasonally favorable. January, different story. January, February, different story. So the last thing that the government wants are people going home for the Christmas, Hanukkah, and I believe it's Hanukkah now, and New Year's holidays, worried about the stock market and the stock market rolling over. Folks, you're going to have the Wall Street big shots. They're going to hop on their private jets. They're going to head out to Vail, Aspen, Stad, and they're going to put the markets on autopilot, meaning they're not going to allow a sell-off in the final 2 weeks of the year unless something really bizarre happens out there. When we get back and it's Q1 of 2022, different story. Now let's talk about that. There are certain factors at play here that cannot be ignored. This Omicron could be ignored. What the government does as a power grab can't be ignored. So I have to preface what I say with that. But I don't want to get into politics. So let's proceed. The Fed admits it has lost control. And he did. Inflation is no longer transitory. We've been saying that for, I don't know, a long time. It's not transitory. It's not going anywhere. It's going up higher. That's the way it's going to be. And the other thing that's going on here is that while the economy begins to roll over, and how I'm measuring the economy is this is the yield curve. This is the 2-year Treasury bond yield versus the 10-year Treasury bond yield. And in a healthy environment, a strong economy, both the two are moving up higher. And a lot of times the stock market doesn't like that because that means the Federal Reserve has to raise rates. At a certain point, they go too far, stock market rolls over, we begin the cycle all over again. So here we peaked out back in March of 2021. And now what we're doing is we're seeing the yield curve roll over. This is a sign that the economy is weakening. This is the bond market saying, psst, psst, be careful, look out, we're slowing down. We're slowing down. Add to that, you have the Federal Reserve, which finally began to taper a little bit, a wee bit. But we know that as goes the bond buying, so goes the stock market. So if the Federal Reserve fails to continue this aggressive bond buying, meaning putting in higher lows and higher highs, what happens to the stock market? It begins to stall out. And it may not be today, may not be tomorrow, may not be next quarter. I'm going to go to a chart in a moment. Stick around. We're going to talk about it relative to the 2000.com bubble. So we have the Federal Reserve that's tapering, the economy which is slowing. What else is going on? Oh, God darn it. We have inflation. This is the CPI. Huh. Inflation, non-transitory inflation. They admit it now. It's not transitory. It's not going away anytime soon. So what does the Federal Reserve do? What do they do? Do they use Omicron as a reason? It's been given to them. It's been given to them on a silver platter. Here, stop the taper. Blame it on Omicron. Kick the can down the road. Keep the party going. We have the midterms coming up. You got to read into this stuff because anybody on Wall Street, anybody in politics has a second grade education when it comes down to the mathematics of why the stock market is moving up higher relative to the Federal Reserve's balance sheet understands that this will not end well if the Federal Reserve, their balance sheet begins to roll over. The only reason why over the past year, 2 years, 3 years, that the stock market has continued higher is because the Federal Reserve has been buying all the debt and spending out of Congress. Now, Congress wants to print more. They want to spend more. But what if the Federal Reserve finally does a Paul Volcker and says, hey, we're done. We're done here. We got inflation ripping through the ceiling. If that happens, look out below. What else is a problem for this market? They want to blame this. They want to blame Omicron. Don't let them take parking space up in your head. Don't let them do it. This is not the problem. The problems I've gone over already are a Federal Reserve that's been boxed in. Do they choose the stock market or do they choose to fight inflation? You got to have one or the other. Do they choose to bail out the economy when the bond market is now saying, hey, lower highs, lower lows on the yield curve? We got problems. Or do they choose to fight inflation by reducing their balance sheet? And by reducing their balance sheet, they take the air out of a strongly overvalued stock market, which is propped up by what else besides the Federal Reserve's balance sheet? Debt. Margin debt is at all-time record highs. This is margin debt relative to, I chose the Wilshire 5000, the largest index that you have out there. This is the total market. And you have margin debt in red. I believe this is as of October. And the Wilshire 5000 in blue. For context, here's the dot-com bubble right here. We are now here. This is unsustainable. And the thing to remember is that when this ultimately does go, it's going to be the margin debt that causes that sickening feeling in the morning where you've just had a 1,000-point, 2,000-point down day the prior day. You go to sleep thinking, man, there's got to be a bounce the next day. But then you wake up and the futures are down another 1,000, 2,000 points. We've been there. We've been there before. This has happened before. Why is this happening? It's called deleveraging, forced liquidation. So the purpose of this commentary is not to have you sell your stocks, but it is an effort to try to put the fear of God into you of what could be, what the catalysts are out there that could send this market down. We are not cheerleaders here. I fully intend on taking advantage of a down market. It's all good. There's plenty of money to be made in a bear market. The stock market takes the escalator up, but the elevator down. There are going to be plenty of opportunities trading the downside of this market. The question is, when? When do we enter that trade? I have been chomping at the bit to short this market, but I fought it off very, very aggressively because we are at that time of year where it's seasonally favorable to be long of stocks. And frankly, today, I think we may have seen a short-term turning point in the stock market. We're probably going to begin to base and then inch back up into the new year. So the question that becomes, if not now is the top in the market, when could it be? It's a good question. Here's a chart of the S&P 500 on a monthly time frame going back. I haven't gone to comments yet. Sorry about that. That's really rude. We'll go to that chart in a moment. Paul, good evening to you. Sorry, I'm not saying good evening to people. Saki is an Obama mole. All one needs to know. Very good, Curtis. Dale, preach. Johnny Figs, new member. We believe in freedom here in Florida. Hey, brother, what part of Florida? Mostly. William. Sorry, Bob, I'm late. How are you? I'm doing good, brother. Glad to have you here. Hey, Bo, top of the evening to you, pal. Tampa. Hey, I'm just back from Tampa. I'm literally just back from Tampa a couple of days ago. Great town. Okay, so here we have the chart of the S&P 500. Going back to 1997. And I want to take a tour down memory lane for a moment because history may not repeat itself, but it certainly does rhyme. Markets absent a geopolitical event rarely just roll over and go down like they did here during the GFC. Normally, it's a process. And there are a lot of fakes involved. And case in point, you had a Fed-driven market rally in a very, very healthy economy with debt nowhere near what it is right now. Back here in the late 90s, I was trading it. You didn't need a fund manager. You didn't need a hedge fund. All you needed to do was buy a stock and it went up. Literally, it was crazy. And I would argue a better market than what we've seen. But we broke down on the S&P 500 a couple of times on a monthly time frame back here. I think this was the breakdown of the market when Greenspan went in front of Congress and he said the market was getting frothy. What was his statement? What was his comment? Irrational, exuberant comment. And the market sold off. I think that's what that was. They sold off. And the markets bounced back. Then we broke down again here, September of 99. Yet we rallied back. We broke down again here, January of 2000. This was really the beginning of the end. And we went into a blow off top in the market. I remember it like it was yesterday. And then we consolidated sideways for several months. Ultimately, we rolled over and we broke down. This is what I suspect is going to happen if we don't wander into a war with Russia or China. You never know. I suspect that that's probably what we're going to see here. Now, how do we line up or overlay these two charts? Well, we've already broken down on the S&P 500. We broke down on the S&P 500 back in September. It's already happened. It's not will it happen. It's already happened. And we've already blew past, went up to new all-time highs. But then this thing happened here. A bearish key reversal bar in November. We were higher, new all-time highs, ultimately closed lower. That is a signal by the market. That is going to be difficult to overcome. You saw that back here in July of 2000, and we were able to push on to new higher highs, but ultimately we put in a lower high and failed and rolled over, broke down to new lower lows. So when was the time to sell this market? Okay, so here's your double top, your lower high. In and of itself, not a reason to go dumping your stocks because you don't know whether or not you're going to break down to a new lower low, or do you go into a multi-month to a multi-year consolidation? You don't know. The time to sell the stock market was right here. October of 2000. That's when we began to, you had to get out. You had to get out because at that point in time, we broke to new lower lows. So while you certainly didn't get out at the top, you would have certainly avoided this multi-year bear market. So while this doesn't seem like a genius move on my part that gets you out right exactly at the top, that's not my job. My job is risk management, not to make a profit. It's not to lose money. So how do we replicate this moving forward? Well, we really don't have the data here to do that quite yet because we only have our first leg of a potential double top. We don't know whether or not it's going to be a double top. We don't know whether or not we're going to get a quick pullback. The Federal Reserve gets scared because of Omicron or whatever next variant they come out with, and then they start boosting up the balance sheet again, salvaging the stock market and sending it up higher. We're not going to make the foregone conclusion that the Federal Reserve is actually going to fight inflation. We're not going to do that. I'm of the opinion that they're going to ignore it. Why? Because they want to inflate away the debt. It's a secret tax, a silent tax on the American consumer, and that's what they want to do. They want to inflate the debt away. So keep I'll share this chart. You should keep it handy. Don't panic. Don't go listening to Omicron and sell your stocks. Don't let them take parking space up in your head, because remember what was happening back here. Back here, when you went into 2000, going up into 2000, you had a massive spend on servers. It was Y2K. Most people out there probably have no idea what the hell I'm talking about. Back in 1998, 99, nobody knew when we turned the new century whether or not computers were, this is not a joke, were computers were going to go back to zero or would they go to 2000? No joke. They had no idea. So people bought all brand new servers. Then the party came to an end. But all through here, this consolidation, all this were the big boys, institutions getting out. There is no way that they have enough pool of liquidity to dump all of their QQQ stocks. Trillions upon trillions of dollars worth of stock need to get sold to make the hedge funds, the banks liquid and to get net short the market. They're not there yet. They need that pool of liquidity. They need to create a story. They want the sell off. They want the rally back, a feel good moment going into New Year. Then they want to be able to churn the market, get you excited, then they sell. If you ever wonder why the stock market, why do the futures open up green, then close red? Why does that happen? The reason why that happens is that they goose the futures. This is why I always say, don't go buying stocks before 3 p.m. Don't do it. The reason is they want to get you excited. You wake up, you check your CNBC app. The futures are bright green. They're up 1% on the Russell 2000, maybe 0.5% on the S&P 500. They want to get you in there running, throwing your money at the market, the first hour of trade. Then what do? Pool of liquidity, dump. Don't let that be you. That's what they've been doing all week. Today was the first day they didn't do it. Let's go to the weekly charts. I've gone way overboard here. All right, not too bad. All right. Let's go to the weekly charts. Let's talk about how we're setting up into the closing week, I should say, closing of the week. Cody. You remember Y2K, huh? It was bananas, right? Cody again. I'm finding a lot of value in this. Thank you. You bet, my friend. I thank you for saying that. I really appreciate that. Okay. Let's Johnny Figs. Is that a good general rule? Never. Oh yeah. Remember what this is not. So Johnny is fairly new to investing, which is fine. Rule number 1, stay small. When you're opening up your positions, stay small, stay humble. You can, it's the equivalent. By staying small, you stay humble. That way, if you need to stop out, you stop out small so that it doesn't hurt your ego. This is not a game against you versus them, meaning the banks. It's a game against you versus you first. It's all a psyops game. The banks have mastered it. Now you have AI and algorithms playing the same game, but at the push of a button. So you need to understand your competition. First off, when you're shaving in the morning, your competition is you. Will you derail your own game? I've done it to myself. I'll do it for myself time to time. I'm not impervious to it. We're human beings. We are not perfect. But when it comes down to the 3 p.m. rule, absolutely, you should never, ever, ever buy a stock that you're looking to swing trade before 3 p.m. Why? Suppose it's up on the day. Let's say 1-2% on the day. Looks like a beautiful key reversal bar. What's a key reversal bar? This is a bullish key reversal bar. Right here. So at 12 noon, this is what the candlestick looks like. Right? Looks pretty good. God damn. I don't want to miss out on this. you start looking at that chart and you say, man, this looks like a really good setup on the chart. Really good. It can't not go up tomorrow. This is going to be a great close, and you start talking yourself into the trade. Now you're your own worst enemy. Don't blame the banks. Don't blame anybody else but you. And believe me, I make this mistake to this date. And rarely is there a time that I don't execute a trade early that I do not regret it. Rarely. So the 3 p.m. rule, yes. Why is the 3 p.m. rule so important? Liquidity. The banks know that there will be a pool of liquidity. Remember, these are big volume bars, big blocks of stock coming down during times of peak trading. They're positioning for tomorrow. So all day long, XYZ stock may be looking like this. Beautiful, beautiful. It's got to close strong. It looks so beautiful. All of a sudden, by 3 o'clock, you begin to see a little bit of weakness. 3:15 doesn't look as good as it did earlier in the day. By the close, it's red and down on the day. But you bought at the top. That's exactly what they wanted. Don't let that be you. Don't let that be you. They baited you. They know what you're thinking before you know what you're thinking. They know your behaviors. Don't let that be you. Wait till 3 p.m. Larry, fairly high volume on Tuesday, Wednesday, Bob, both down days. How significant do you think? Those are both churning days. Those are both days that I mentioned earlier that where you saw that pool of liquidity, the futures are bright green, and then they reverse it to close lower. There was no doubt institutional distribution. There's no arguing that. I think that they took the bait. Believe me, these hedge fund managers are not geniuses themselves. All right, so what did they do? They took the Omicron bait. They bit this. They were playing checkers and not chess. Or they're looking at the charts that I showed you, and they are playing chess. And they're looking at the Fed's balance sheet rolling over, appreciating the fact that, hey, there's a direct correlation between the S&P 500 and the Federal Reserve's balance sheet. Here's the max chart since 2019 to present. Here's the S&P 500. 2019 to present, right? You can't make this stuff up. It's fact. So if there's a direct correlation and the Federal Reserve has every intention of rolling off debt off their balance sheet to fight inflation, why stay in stocks? And if they could create that pool of liquidity in the morning to get people excited, and they could offload some of that risk onto the unsuspecting retail buyer, so be it. I think now people are going to simmer down with this nonsense, and they're going to allow this market to rally back some into the new year. At the beginning of the new year, though, all bets are off. I think we're going to see some volatility. They're not going to let this market go straight down. They got to book profits. They can't just start dumping, 100,000, 200,000 share blocks of stock of Microsoft, Apple every single day and lose all those profits. They can't do it. They want to keep the market in a sideways motion, create excitement, sell into it, create excitement, sell into it. That's all that they're going to do. That's what this was back here. Right back here. So here's January. Why can't I get January up here? There's January 2000, right? Blow off top, pull, excitement, backing, filling, big funds exiting trades, retail investor, can't lose money, high margin debt. All of a sudden, rug gets pulled out, bear market. Simple as that. We've been there before, not to a great extent as what we saw back here during the great financial crisis, because you had Bear Stearns, Lehman that went under, and those were macro events. Those were binary events. So they didn't really have the time to keep the market going several rounds to get liquid. They had to dump as quickly as possible, thus causing this huge forced liquidation fire sale. It was bananas. So anyway, let's get to the weekly charts. VJ Jojish, thanks for the information. You're welcome. Thanks for being here. Just folks, if you could please smash the like button, I'd really appreciate it. It helps me out quite a bit. All right, let's go to the weekly charts. Let's talk about, I think more so than the weekly charts this week, which is rare. I like the daily charts of today. So we're going to spend a little bit more time on today's daily price action. All right, real quick, bond market, bond yields. Now, keep in mind that the Federal Reserve has come out the other day, only, 2 days ago? Tuesday. What's today? 2 days ago. On Capitol Hill, you had frickin' frack, Yellen and Powell up on Capitol Hill. Inflation is not transitory. We're going to have to speed up taper. Stock market sells off. You would think that bond yields would go up, right? Wrong. They didn't. They're down. Why would bond yields go down? Remember the chart of the yield curve I showed you before. The economy. The economy is in all probability slowing. So you're seeing bond yields go in the wrong direction. TLT, 20-year bond ETF, broke out this week. Fear, money leaving stocks, going into bonds. Treasury inflation protected securities. Hey, they don't care. They don't care about Powell and his taper. They don't care about the Fed's balance sheet rolling over. It's too late. CPI, Consumer Price Index, going through the roof. It's too late. Yes, we're consolidating. For those people not familiar with what we're looking at here, this is the tip market. Treasury inflation protected security bonds. You buy them to protect your investments against inflation, or protect your cash against inflation. Now, you would think with a Federal Reserve chairman on Capitol Hill, man, you got to dump these tips because he's serious now about fighting inflation. Got to get rid of them tips. Tips are down, what? 0.16% on the week. They're not buying it. Nobody's buying the BS. Daily chart. Today, bullish key reversal bar. This is why I mean today was more of an interesting day versus the weekly charts. Usually the weekly charts on a Thursday have me more engaged with them than the daily charts, but today is an interesting day. So let's spend a minute here. Let's war game out what the bond market, the tip market, is saying about inflation. Remember, the Federal Reserve is now, they're serious now. It's not transitory. We're going to taper faster now. That's the jawboning. They're jawboning. They don't want to act. He wants to be able to talk and hammer down inflation. They want to use Omicron, fear of a shutdown, knock back energy prices. We're going to talk about that in a moment. The last thing they want to do is to fight inflation. Because to fight inflation means really speeding up taper and raising interest rates. They can't do it. They can't tell you they can't do it, because if they were to normalize interest rates, let's say the 10-year yield was at a normalized rate of 5%. If you raised up the 10-year yield right now to 5%, the interest payment alone on our debt, forget about the principal. The interest payment alone would be the equivalent of our defense spending. Think about it. That's $800 billion a year leaving the country. You're talking third worldism. So bullish key reversal bar, we're in a consolidation here, daily time frame tips. We begin to break out above this upper band of resistance. Look out. You got to start looking at gold and silver again. They've been whacking them down. We were buying gold mining stocks today. The dollar. Up on the week, doji star formation. Still not a bad chart here. This is a pretty good looking chart. So while I think that longer term, the dollar is going to roll over because we keep printing so many of them. Right now, in the short term, the dollar looks pretty strong. So we don't want to talk our book and to really support our book, our longer term book of stocks, our core portfolio. I got to jawbone down the dollar because a weak U.S. dollar helps our portfolio. I'm not going to be intellectually dishonest. This is a good looking chart, a very good chance that we continue up higher here. Let's go to a daily chart. Daily chart, good back-to-back days here, bullish key reversal bars. Now, if we break down below 95.54 on the USD, the Dixie, big problems for the US dollar. I'm not seeing that right now happening, but you are seeing your momentum in weaken up. They're still not broken. They could still recover and hook back up. So just something to watch. US dollar still looking strong. The VIX, let's make sure these are updated. Good. Weekly view. We're holding the weekly breakout above the 25 mark on the VIX. We closed at 27.95. Let's go to a daily chart. A bit of an inside, not a bit, an inside day today. No new high, no new low. We left the day yesterday trading out above, or into, I should say, not above, into the third standard deviation Bollinger Band in green. Not in and of itself a worry for the VIX because it's so volatile, but it's not shocking to see a pullback off of that level. It's expected, but I wouldn't have been shocked to see it proceed higher. Stokes still look good, gaining momentum. So while we had a down day, we're certainly not out. Now, here's where things get a little bit interesting. And again, I'm more interested in today in the daily charts than I am the weekly charts. So quickly on the weekly chart, we still have a down week, down over 1.5% on the Dow transports. On big volume, this is institutional selling. Stokes going in the wrong direction, but still above 50. So we can't count out recovery in the Dow transports. But yields, with yields pulling back, remember what signal that sends to the industrial sector. What that sends to the industrial sector is that the economy is slowing. So why do I need so many transport stocks? Do I need all that shipping? Do I need all those railroads? Maybe not. The economy's slowing. They're not going to do as well. So that's why you're seeing weakness in the Dow transports. Now, to the daily chart, here's where it gets a little bit interesting. This is a nice recovery day today. We put in a new daily low, yet we recovered very, very nicely, closing up nearly 3% on the day on big volume. So this is what is giving me an indication that they may be setting up for the Santa Claus Rally now. I'm not saying that we're going to go skyrocketing straight up higher. I'm not saying that we can't have a reversal month and close even lower on the month of where we're at right now. All I'm saying is that we're being sent signals right now that we may be getting a rally. It may be short-lived, but a rally nonetheless. The Dow Jones, a down week, down nearly 3/4 of a percentage point. Stokes really weakening up here. And we're down below key support at 35,000. But what if? Let's play the game. What if? What if they close the Dow above 35,000? Am I going to be as bearish as I am right now? Not really. Not really, because we have defended a critical support level. We closed out the session at 34,639. It's not a big stretch to close back above 35,000 by the end of business tomorrow. Daily chart. Now, the daily chart, an inside bar. No new high, no new low. This is a signal of a potential bottom, however short-lived it may be. I'm not saying we're going to new all-time highs. I'm not saying we're not. I'm not saying that we are, because the test is always at the top. If we rally back, do we break out to new all-time highs, or do we put in a lower high? I'm not that smart. The market's going to tell me that. But short term, this is good price action, a sign of a potential short-term bottom. Now, the S&P 500 weekly chart. Now, what's happening on a weekly chart Thursday night, end of business. This is in the books. One trading day left to go. We were trading down below critical support. We are now back above it on Thursday evening. Do we defend it tomorrow? Do we close above it? We'll be watching very, very closely. We'll talk about it more on Saturday with members. Daily chart. Again, a very interesting reversal bar today. This can't be ignored. The probability of us gapping down tomorrow and taking out today's lows is highly improbable. It could certainly happen. It wouldn't be the first time I've seen it, but it would certainly be a rare event. So this is a good setup for a consolidation, or B, a continuation move up higher. Small caps, which have been beaten like a redheaded stepchild. I have been a stepchild. I have strawberry blonde hair. I'm allowed to say that. Am I part of a victim class? Weekly chart down 1.63%. We are clearly down below not one support level, but two. Remember, small caps do well in a rising interest rate environment. Why? Sign of growth, expansion. Times are good. What are yields doing? They're pulling back. Yield curve rolling over. What is that telling the small caps? Hunker down. Capital may get tight. Be careful. Stop with the spending. Get ready for a recession. So that's what you're seeing right here on this chart, are the small caps getting sold off in preparation for a potential recession. Daily chart. Beautiful day. An inside day. You could argue, Bob, I'm seeing an oversold condition here relative to the third standard deviation, two standard deviation Bollinger Bar. Fair point. What was it conceivable that we would get a counter trend move today? Absolutely. But this is certainly not short covering. This is institutional accumulation. The Trip Qs, the Pimp Mac Daddy of them all. Weekly chart down 1/3 of a percentage point on the button. 390 critical support. We closed out the day at 389.91. One trading day left to go. I think they're going to defend that support level. Daily chart. Today we recaptured what was a breakout point. Failed yesterday. Today we recaptured. Stokes still trading down below 50. I do not like these Stokes at all. At all. So we may bounce around here. We may not close above that 390 mark. We may retest the support level in blue yet again once or twice more. Because when you get Stokes declining down below the 50 mark, rallies tend to fade. Rallies tend to fade. So do not go chasing bright green futures tomorrow. The banks. We're long on the banks. I have a position in the banks. We've given them a lot of leeway. I do not like the fact that yields are rolling over. It's not good for the banks. Banks like rising interest rates. It helps their margins on their loans. So I'm going to be watching with bated breath to see whether or not we hold this lower band of support in blue on a weekly time frame. Because on a daily time frame, we've already closed down below that support level. We attempted to recapture today, but failed. Couldn't do it. So if yields perk up higher, here's the 10-year yield again. Let's go to a daily chart, see how they closed. Update. That's why you saw strength in the banks. If they continue higher here, expect more strength in the banks. If you don't get that strength on yields, I would avoid the banks. Technology, up week so far. Doji star formation. Folks, this is a continuation breakout pattern. You want to create a bull flag formation, you want to call it a wedge formation, call it cupcakes. It doesn't matter. As long as we don't break down to new lower lows, this is a consolidation. And if we break out, we're going off to new all-time highs. I love these guys that look at the charts and they're staring and they go, oh, you know what? This is going to break. Guaranteed it's going to break. You got to sell your stock. How do you know? How do you know? Be humble. If it breaks, then you act. And only concern yourself if you close there, if you're using a weekly chart, if we close there on a Friday afternoon below the support level, then you got trouble. If you're using a daily chart, if it closed down below that support level on a daily time frame, then you got trouble. If it trades down below the support level on an intraday or intra-week basis, doesn't matter. Watch for where it closes. That's what matters. All too many people want to divine what the stock is going to do next. Stokes on technology are not looking good. I got to say this. I'm a big advocate of using your stochastics for momentum. And, I have a bullish tone to me. And I do expect to see higher highs in the market going into the final 2 weeks of the year. XLK has got a little bit of troubles here. And I'll illustrate, we'll memorialize so we go back and see how this was resolved. Because this is no bueno. I was just down in South Beach, crash course in Spanish, did very, very well. South Beach was awesome. Really cool place. Never saw so much rap money in my life. Watch for a breakdown in the close below 165.33. We break down below that support level and we close there. Major problems for the XLK. Now, what I see probably happening here is that we bounce around. We retest this support level. It probably holds. We rally back and we do one of these numbers. Here's your lower high on technology. Today, technically, we broke down to a new lower low on technology. Had we closed there, I would be singing a totally different tune right now. But we didn't. We reversed to close higher on the day. But if we break down below the support level, man, look out below. If we rally up into this upper band of resistance, that's going to mark your upper band or a test of the upper band of a declining, I won't call it a downtrend channel. Let's call it a declining resistance because we haven't broken down yet to new lower lows. So I want to be careful with my hyperbolic statements. Abel, smash the like button. Yeah, please smash that like button, please. I got these kids. They got like 30,000 views on a video. I got like, I don't know, 100. It's so demoralizing. It really is. I got to rent a Lamborghini. All right. Semiconductors, weekly chart. This is a tough one. You know, in a case like this, a time like this, all I do is I do this. I punt. I do one of these numbers. I default to the market. Mr. Market is going to tell me what's going to happen. So I'll tell you what has happened and is already in the books and what might happen. All right. So what has happened? What has happened is we've seen a bull trap on the semiconductor sector. Cody, just found you, but I'll make sure to share your video. Thank you very much, Cody. Appreciate that, man. We had broken out back here the week of November the 15th. What happened the following week? We put in a new all-time high, then closed lower. That's a bear trap. Couldn't hold this breakout point in blue, but we have held support at what's the low here? Low 298. It's called 298. We haven't broken that support level so we don't want to read into what the market may do and act upon it. We want to react to what the market does, so that way we're not getting whipsawed. So as long as we hold the support level, all we're doing is we're consolidating gains. That's it. So we don't want to go shorting because we had a bull trap. We've had no follow through to the downside. So we're going into a seasonally favorable period of time, and I want to go shorting the market? I don't think so. Not yet. So we're holding support. I think that we may see a hookup on these momentum indicators. RSI is already doing it. One trading day left to go. Volume so far in the week, up and very, very high. One trading day left to go. We're up about 1 3/4%. It would be a pretty dramatic drop if we were to give up those gains and turn red on the week. So the probability is improbable, but you never know. Daily chart, semis. I don't like the Stokes. We saw it with the XLK. We're seeing it with the semis. It's not good. I would not go buying the semiconductor sector. I would not go buying the semiconductor sector. I wouldn't go dumping my entire position. Might I trim some if I had gains? Yeah, but I would not initiate a new trade, nor would I add to my existing position. Why? Stokes trading down below 50. Rallies tend to fade. Also, double top. Do we break down to new lower lows? We don't know. We don't know. All we do right now is we take a look at the chart and we say, okay, the market's told us a couple of things. One, we're losing momentum, right? We're putting in lower highs, lower lows. Check that box. Not only are we doing it on Stokes, we're doing it on RSI. Lower highs, lower lows, downtrend channel. Then you take a look at price, because price and volume, those are the most important things. Forget about your indicators. Price matters most. What is price doing? Well, we got a double top here. But it's truly not a double top until you begin to break down to new lower lows. We haven't done that yet. So all I know right now, for all I know, is that we're in a consolidation range. We're not going to pound our fists on the desk and say, we got to get short this market. We have a double top. We have the Stokes decline. We're not going to do that. That's stinking thinking. At best, we are consolidating gains. We're setting up for the next leg up. Why? Because the path of least resistance on a monthly and weekly time frame remains to the upside. And plus, we're in a seasonally favorable period of time. Volume, very good. What time do we? 7:07. I had to blow through these. LABU. Loving LABU. LABU members, we're going to be talking about LABU as soon as tomorrow. You may be looking at me going, Bob, it's down on a week. I hate this. What's wrong with you? Are you on drugs? No, I'm not on drugs. Unless you consider CBD and Motrin drugs. Why do I like LABU? We're off the lows. We're defending 40. I still don't like the Stokes here, but when you take a look at the daily chart is rocking. Let's tell the story. Double bottom setup on your stochastics. Higher lows. We are now beginning to break out. RSI. What is it doing? Hooking up. Today, bullish key reversal bar. It did so on volume. What's not to like? Members, stay tuned. Tomorrow, we're going to be talking about LABU. Energy. We booked profits this week on one of our energy stocks, ETRN, which is a pipeline company. Paid a nice yield, but what's the yield worth if you're losing all the yield plus some on your net asset value of the stock? So we had a profit. We made it real. I didn't like the chart. We're out. You're seeing bond yields roll over. That's not good for energy. It indicates a slowing economy. Who needs energy in a slowing economy? Blah, 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 blah. So that's why we're out. Then you take a look at natural gas, beaten like I already said redheaded stepchild. I'm not a unique person. I have a mind of a banker, hardly unique. We fell apart this week. This is a leveraged ETF, so keep that in mind, down 42%. So this is probably an opportunity, but not right now. Oil rolling over. I got to check out home heating oil prices. I'm probably going to fill up, take advantage of this pullback in advance of the winter. Winter's here. Emerging markets, really quick. Bullish reversal bar, still not liking Stokes. We're in a downtrend. Avoid. Gold, what can I say about gold? They hammer gold because they're worried about rates rising because of inflation. Then you get Omicron. They're worried about deflation. What do? They sell gold and the gold stocks. You can't make it up. So gold got hammered today. This week, I should say. It's down over 1.25%. The dollar is certainly an influence on. Let's go to a daily chart today. It closed at the lows of the day. Wow. So not looking good. But we did go buying more nugget today. We were looking at the daily chart. We defended 44. So we nibbled a bit more here on this pullback. So I think that's all I got to say about the weekly charts. Let's do a couple of chart requests. I got to go to members first. I'm going to sign off here because I'm going to lose my voice in about 10 seconds. Members and requests. All right. Ticker Cloud. Franklin, I did Joe, so we already did that one. Okay, cool. I think I had one request, VTI. I'm going to sign off after VTI, folks, because I'm starting to lose my voice. Thanks for putting up with me so far. And don't forget, we're going to be using TrendSpider, folks. Automated technical analysis. I traveled 9 states, 3,100 miles. This app never failed me once. Perfect for what I needed to do. Franklin, thanks again, Bob. You always take me back to school on my trading and learning about the market. That's a compliment that means a lot to me. Thank you very much, Franklin. That's very, very sincere that I say that. Thank you. Okay, let's do VTI. Yeah. Larry, yeah. Strong performance tonight, Bob. Florida trip revitalizing. Yeah, I'll tell you, man. Sometimes you got to take a break. I hadn't taken a break in a long time. And, you get nervous. You have a small business and you worry. You don't want to get disconnected from your members. And you got to find that balance, but you got to rest. So, yeah, coming back, no doubt, revitalized. You're 1,000% right. So it's a fine balance that you got to work with. So, what do we have here? All right, we'll do PayPal and VTI, and we'll log off. We did a PayPal trade. We traded PayPal while I was on the road, earnings, and we did a swing trade on it as well. Profits on those trades. We'll do VTI first. Do I know VTI? Oh, total stock market index. Yeah, for seasonality. I'm looking at this at the corner of my eye. Look at the seasonality. November, December, very favorable. April being the best. Oddly enough, I wouldn't have guessed that. I would have said December. I wouldn't have said April. Okay. Monthly chart, VTI. We're down, but we're not out. I mean, it's not a bad chart. But we have broken down. I always do that. We have broken down below the rising uptrend channel on a monthly time frame. We did so back here in September. I mentioned that earlier when we went over the chart of the S&P 500. We have pressed to new all-time highs. So we're beginning a new round of support levels. Simple as that. Basically waves. We're working with waves here. So I'm not going to say simply because we broke down in September, that's the end of the bull market and the total market index. It's not. This can go on for a long time. We saw that earlier when I went over the dot-com crisis. It took months to top out. It was a process. Absent a geopolitical event, Lehman Brothers, Bear Stearns, terrorist attack, war, absent those events, or pandemic, bull markets rarely just stop and go negative or go down. It's a process. Institutions need to get out. It takes time. It takes a lot of shenanigans, getting retail money in so they could sell. So right now, to me, the path of least resistance remains higher on the VTI. Weekly chart. We've pulled back, tested the lower band of support. Little bit of a bounce here. We're down on big volume. This is institutional selling. We're down about 2% on the week. We were down 2.62% last week. So not an insignificant move. When do you buy? Let this consolidate. Wait for the breakout above resistance, then go buying. Daily chart. The daily chart looks good. It's consistent with the other charts that we've gone over on a daily time frame where we've held daily lows, reversed to close just shy of the highs of the day. So to expect a gap down tomorrow, highly improbable. Can it happen? Of course it can, but it's highly improbable. Does the support level hold? We don't know that. We're not that smart. We don't put that much strain on our shoulders to anticipate that. When do we know that it's safe to go back in the water to add to our positions? Well, when we break out, when we see enough strength on volume and we close above this upper band in green. It's not rocket science. These guys go on to CNBC with the $5,000 suits, slick back hair. They talk in basis points rather than saying, hey, a quarter point cut or a quarter point increase. They want to use big, fancy 25-cent words to confuse you, to make it think it's complicated. It's not complicated. All you do is take your crayon out, draw a couple of goddamn lines, wait till 3 o'clock, see whether or not we've held those support levels. Does the chart look good? Then you nibble. If not, you avoid it. It's not that simple, but I'm trying to be entertaining a little bit because I know I have a real serious face. PayPal. Zaki, I hope that answered your question on VTI. PYPL. PayPal, I'm honestly looking at as a long. We were forced to book profits on this one because we bought in here post earnings. It rallied. Then they got that downgrade. That's what it was. They got a real scathing downgrade. And I thought it would shake it off, but it didn't. It really began to pull back. And I said, you know what? I have a swing trade profit here. We just made money on earnings. We have money on the swing trade. I said, you know what? Let's make these profits real. Get out. And sure enough, man, it broke 200 and wow, dropped down to 180s. But I'm liking it. But let's not begin with a daily chart. That's against our rules. We begin with monthly or weekly charts to begin our analysis, even though I just traded this twice in the past 2 weeks. So the monthly chart, we are in a new month. The first question is, have we put in a new monthly low? Well, last month's low, 180.50. This month's low, 179.15. Check that box, new monthly low. That's in the books. It's happened. You don't want to see it close down below 179.50 or trade down below 179.50. So if you're going to open here, now you know where your stop loss has got to go or tighter. Weekly chart. Weekly chart not looking bad. We're down on the week by about a percentage point, but we're off the lows of the week. What are we also going to do right now? We want to check out seasonality. What does PayPal normally do? There's not a lot of data here. I don't think there's much more than 6 years on PayPal. No, there's not. Over the past 6 years, up 71% of the times in December. Remember, very thin data, only 6 years, so be careful using that data. So on the week, looking good. We're holding support. We're at a buy it tomorrow. I know exactly where I'm stopping out, right below 179.50. If we break down to new lower lows month over month, we're out. Daily chart looks good. So this is one where I might buy the common, use a tight stop, or I would use a strangle trade, which is the sale of a deep out of the money call option and simultaneously a deep out of the money put option. What do? I generate cash flow. If my call side or my put side doesn't get tested and the options expire worthless, I'm using time as my friend. If you're an options buyer, time is your enemy. So this is not one I would buy options on. I would either buy the option, I would either sell the options, generate cash flow. And if I sold a put and I had the shares put to me, I would always find a historical support level to find my strike prices. For that, we got to go to a monthly chart. I would entertain down here. A 175 to a 175 strike looks pretty interesting. 175 to 170 strike. 170 is very, very conservative. Sell a put down there. Sell a call up here at around 233, 235, because you have a lot of resistance up there. And that's your brackets. That's where you sell your options at. So PayPal looking good. I think that we could quite possibly rally into the back half of the month. My voice is now officially shot. Folks, thanks for joining in. I appreciate it. Don't forget about the 35% discount code to TrendSpider. Don't forget about our 14-day free trial offer. Take advantage of it. Links below. And everybody, I really appreciate you being here. Thank you for spending time with me, and have a great night. Be well.